credit investors like to minimize uncertainty. And things like interest rates, where's the 10-year going to move, where's the 30-year going to move, those are definitely factors that are difficult to forecast. Our chairman, Howard Marks, has just recently spoke about that. And if we can minimize that by focusing on shorter duration assets that have higher yields, that's a way to kind of minimize some of that volatility and I think provide what will ultimately be a more consistent return over time.
So stick to short duration is what you're saying. In your notes, something stood out to me. So you say high yield, investment grade, and loans are doing well. Is there a geographical spread? Because we had Asia credit market guest on, the strategist from Goldman Sachs yesterday, saying that he actually saw a pretty meaningful spread decompression. So a lot of uncertainty being detected in the markets. So is that something you're not seeing?
I think, part of this is you have to think in terms of relative moves and relative value. So, have spreads moved wider in the U.S.? Yes. Have spreads moved maybe a little bit less in Europe? Yes. And I think there's reasons for that. You see a lot of capital flight coming from the U.S. into Europe. But, again, if you look at, say, the high-yield bond market, down 2-ish%, that's not too bad considering equities quickly went down almost 20% from their peak. So, I would consider the credit market still pretty resilient despite some of that, resetting in spreads that we've seen over the last, couple of weeks and really the last, call it 6 weeks since mid-February.